And with that, we are going to consider, again, we're always looking to the future here in our conversations with global investors. And mega trends, whether they be physical, social, cultural, they intrude onto the world of investing. And sometimes really, whether it is ESG, it is technological revolution, or even changes in managerial thinking, they all impact how we do private equity investing. And fortunately, our next panel is very well equipped to deal with this, and we're going to be having a discussion. Once again, I'd like to remind you to use the QR code that should be active now for this panel. Our group is going to be ably led today by Janet Perumal, who is a Senior Managing Director and Director of Investments, as well as the head of Hong Kong and China for Wellington Management. She is going to be leading a group. We are going to be welcoming Juan Delgado, who is the Vice Chairman at Hamilton Lane. Also joining us today, Janet, thank you very much for coming up, is Nate Sleeper. He is the CEO at CD&R, and completing our panel today is Mr. Hemant Taneja, who is the CEO and Managing Director with our friends at General Catalyst. So, ladies and gentlemen, and especially Janet, go for it.
Thank you so much. Good morning, everyone. It is a pleasure to be here, and I want to just say thank you so much to HKMA for a fantastic conference. There's been so much rich perspective, content, facts and opinions shared as well. So I'm super excited for this panel. From a private equity perspective, we've got multiple perspectives along the private equity spectrum, and I'm really looking forward to the conversation with these gentlemen. So getting right into it. The rise of private equity over the last 40 years has really coincided with sort of a long and gradual decline in the interest rate environment, as well as ample liquidity. So now we've gone from an essentially zero-rate interest rate environment and into something that's new to many. And then on top of that, you've got the geopolitical uncertainties, you've got changes in demographics, supply chain, lots of different trends going on. And so we're going to be keeping in the theme of what are these big trends that we're seeing for the future and how you're approaching it. So my overarching question is, how do you see this market regime changing the way you think about investing from your perspectives? And importantly, what are the new and emerging risks that you're looking to sort of think about as you implement your respective strategies? So I might start with Nate.
Okay. Thanks for having us here. I would say that the title of our panel is a little daunting. The future of investing in 35 minutes is a tough challenge. Clearly the world is an uncertain place. There's a lot happening from a macro standpoint. There's also, when we look at our businesses, we have 45 companies. Usually in more normal periods, our companies kind of move together, different degree of sensitivity to the economic cycle, but generally move together. Right now, because of the repercussions of the pandemic, kind of the post-COVID, post-stimulus, post-inflation, post-shortage unwindings, there's actually a wider dispersion of performance across our companies than would be typical. So clearly we're in an uncertain place. But I would say we're always in an uncertain place. It's just sometimes it feels really uncertain, and sometimes it is uncertain without us knowing it. And maybe by way of example, a little factoid around our own firm. I've been at the firm for 23 years. I've been on the investment committee for most of that. Virtually every investment case that has ever come to our investment committee has had a IRR of 20 to 25%, like just every one of them. And the amount of effort that goes into that, from teams, months of work, lots of debate over small changes, consultant inputs, data from the companies, and so just an enormous amount of work to get that case really, really precise. Our firm's been around for 45 years. We've had exactly 2 companies that have been fully exited in that range. And so we get it wrong every time. We're always wrong. And we don't think we're bad at forecasting. It's just reflective of the fact that over a 5 to 7 year period, the future of the world is unknowable. And so for us, return generation, how we think about returns, that's mechanical. How we think about risk is really where the art of the investment decision is. We think about it, distribution of outcomes, how do we manage the downside risk, how do we emphasize the skew to the upside, and craft transactions that reflect that. You know, as we think about where we are now and some of the changes, the macro changes that we're talking about, transactions themselves will adjust, capital structures will adjust to the higher interest rates, the equity contribution will adjust. So the mechanics reflect the environment that we're in. I think private equity offers three things that are consistent. One is we have capital. Two, we have relationships and creativity. And three, we have governance and operating capability. Capital in some periods can be really valuable, and some it can be a pure commodity without differentiation. Depends on the environment. Our relationships and our creativity, our ability to catalyze transactions that create value for all parties involved, for the counterparties, for our partners, and in so doing, creating value for the transaction that we're making, I think is a real key to what we do. And then finally, the governance structure that we bring and the operating capabilities is, in our view, a superior model over the long term to really drive business improvement. And so I think we'll adjust to those macro factors, and those things that are real advantages in our model are constant. So I think we'll adjust and continue to perform is my perspective.
Can I just ask, you talked about risks and to the downside, and you know, we're going into a more uncertain environment. Are you doing anything different on the downside as you think through the risks?
You know, I would say our whole period is 5 to 7 years. I think Howard Marks said it, there's always a recession pending at some point, and certainly over that kind of time period, we always assume that we're going to be in a negative environment. And so we think about how do we structure our investments to be able to navigate the downturn? How do we identify operating levers to be able to navigate through that downturn? I think actually Eddie and Joseph Yam said it really well yesterday. Contingency planning is everything, and we spend a lot of time on fire prevention rather than firefighting. And so I thought that was a great framing, and we think about it the same way. So that's how we think about it.
Great. Juan?
Well, first of all, HKMA, thank you so much for having Hamilton Lane here. For those of us based in Hong Kong, as I've been for the last 12 years, we get to be in this ballroom often. I don't think I've seen so many people on day 2 of a conference at the Four Seasons. So congrats. I'd say clearly we've had it very easy for a long time, and we've gone from easy to hard. But I think we risk overstating. We've not gone from easy to entirely unprecedented. You know, at Hamilton Lane, one of the things we have is data. We have over $16 trillion of private markets data. And that goes back not 1 year or 10, it goes back 50 years. So we have data from the 70s. There were buyouts in the 70s. Not as many as in the 90s or 2000s, but we had data. And if you look at that data, actually, the interest rate cycles have come and gone. And when you are looking at periods where public equities are negative, that's where the private markets spread outperformance is the greatest. So it's harder, but we have performed. And actually that delta, by the way, now that the advertising ban was lifted in an earlier panel, I can say it's not 100 basis points, it's about 800 basis points. And we're happy to send these data to anybody in the room. So, so this is not entirely unprecedented. That's kind of the good news part of my answer. The not so good news in many ways is what has changed is we probably will have it slower for longer. Slower in what sense? In private markets, which by the way, I entirely agree with the title of the panel, because that's the answer already, right? The public markets as managers talked about the macro, and we talk about the future of investing. So in private markets, we are at the moment investing at a much lower pace than we were investing in 2021 and 22. And that's a good thing. The order of magnitude of that is come down from, if you had, and again, it's just keep thinking I'm referring to all of that data, not to my firm, not to any of these two firms, and we have money with both of them, but at the entire market. So if you were running at an investment pace of about 40% of all the capital that the industry had available to deploy, we're now running at not even 20. So it's less than half the pace. The liquidity that we're receiving, that clients and institutions here are receiving from portfolios is also severely down. And so that's a slower pace, but it's not zero. It's about, used to be about 23%, is now down to about 10, 15%. So slower for longer, is not a major problem. The single biggest problem we had as an industry was the huge size of the vintage of 2007, right before the recession, as it turned out. And the single problem we will have to deal with in our portfolios is the size of the vintage 2021, which is also a record. So again, harder is okay. Slower for longer is okay too. And then I just make a comment about what may change in terms of the different strategies. If you think of the comments you've heard about private credit, which we agree with, is one of the best things to do, you just need to try to put in mind what is the current private markets portfolio looking like. And it's not a 60-40. It's actually more like a 90-10. So private markets, by and large, in big aggregate numbers, are an equity play. So when you hear someone say, put more in private credit, we don't come from a 60-40 position. It's not a massive portfolio bet. It's actually a relatively modest reallocation bet compared to what you're doing in public markets. So the room for growth in private credit needs to be looked at in that context. We think that one of the things that will dominate these discussions over the next 5+ years is these type of portfolio considerations, and they apply to the private markets as well. So we're very focused on them.
Fantastic, thank you. Hemant?
Thanks, Janet. And I also want to thank HKMA. It's been eye-opening to be here, to learn about all the opportunities, especially the Greater Bay Area, and just the company building that can be unleashed here with all the resources. So thanks for having me. So our roots as a firm are in venture capital. So a lot of our focus has always been about building new companies. And so our observations over the last 15 years with this sort of digital transformation of society that we're going through would suggest there are 3 big trends that we have to be thinking about in terms of value creation. And we're on the opposite end of the spectrum from Nate and CD&R, obviously. One of those trends has been going on for 15 years, right? It's been around mobile and cloud, and how do you build new experiences which allows you to create new brands. So we've built insurance companies, healthcare service companies, schools, banks with technology, with sort of a digital-first mindset. That trend, in our view, is going to continue to play on. There's a lot of industries, but there hasn't happened. So in the US, for example, healthcare is just at the beginning of adopting that and opening up to be a free market. There are other industries like defense and industrials and others where founders are also thinking about how do you build full-stack companies. The advantages that the new entrepreneurs have in that regard have been around what I call sort of the superpowers of big companies being made available to little companies. You get access to renting platforms for computation, for manufacturing, distribution, logistics. And with mobile, you get a distribution advantage where you can get early customers to get to enough scale that you become relevant. And that's sort of an unfair advantage for little companies. The second trend, which I suppose has been going on for a decade, but really hit the zeitgeist with ChatGPT last year, is around AI. And AI, first of all, what's really interesting is, every CEO in every company, in every industry, in every country is talking about AI at the same time. That has never happened. That did not happen with cloud. That did not happen with any innovation. So it really did hit the zeitgeist, guys, from a commercial perspective. And we think it's going to be transformative really fast. And this trend, to me, is more about giving superpowers of little companies to big companies. How do you actually go build transformative experiences if you're a big enterprise around customer support, contact centers? How do you do capital allocation and marketing? Think about every department you can redo. And it's the large companies that would benefit. And they would also have large challenges around workforce transformation, for example. Okay. And then the third challenge, and we talked a lot about it from a macro perspective, but I just want to sort of give some anecdotes on how it's hitting, is this is for the first time that there are a set of industries where politics trumps business. And we call that theme broadly global resilience, where whether it's defense or food or semiconductors or manufacturing, you're going to want to see companies built in your nation that take care of your people first and foremost. That has multiple implications. There's obviously structured inflation, and what does that really mean when you build those companies? But then there's also this whole idea that if you are a company trying to be global today, how are you going to build that business? You know, we had a holiday from history for the last 30 years with low interest rates, and you could be thinking about all globalization and always focusing on cost and efficiency. That doesn't happen anymore. So what are the models in which you can actually be a globally relevant new company? Again, I sort of think about the new companies that get built today, and be relevant, but do it in a way that you actually meet the national interests in those critical industries.
Thank you. Really interesting. So, probably going to build a little bit on what you just shared, Hemant, but relationship capital matters a lot in private equity deal making, from origination to sort of attracting top talent for the portfolio companies. So you talked about AI, and I guess I just wanted to ask you, so from a general catalyst perspective, you've got a number of investments across segments and countries. You also have a flood of new entrants into, you just talked about many new companies who all say that they are AI related or have embedded it a lot. So I guess from your perspective, how do you identify what's actually value accretive and proprietary technology versus just being part of the hype cycle or part of the marketing pitch from a technology perspective?
Yeah, it's been an interesting year, 18 months for us, sort of thinking through that question. One of the questions I always ask companies that have been around for a couple of years is, when did you start calling yourself an AI company? Was that after ChatGPT, or were you really starting out as an AI company? The main things I would say around AI, you know, we did this exercise earlier this year to say, which of our companies in software run the risk of being obsolesced by AI? Meaning, founders starting today or in the next couple of years, the companies they build will actually end up being more valuable than what we've been building for the last 5 years with these older stacks. And we did this whole exercise of making sure we integrate the language model technologies into them so they can take advantage of that innovation. In terms of how we think about the innovation that's coming out today, we probably saw about 1,000 companies this year in AI in the Valley, invested in about 6. We find it very hard to figure out how the language model layer is going to, on its own, capture value. That is a very difficult challenge because it's a big capital game. And if you think about a lot of these language model companies, they'll go spend a couple $1 billion, they build a model, and the very next step is go spend a couple $1 billion and build the next model. That's not how you recoup investment on your capital in your products. And there's this arms race there towards commoditization, which for us is very hard to figure out how to capture that value. We think on top of that, the idea of applying these capabilities around reading the entire internet, which is what these open language models are, and then applying it to different industries is quite interesting. So earlier this year, we started a company with this interesting team in the Valley where we partnered with 30 health systems. They contributed their data, which is private data, and we bet, let's go build a language model for healthcare that's safety first. So it's applied in a way that it's really designed for clinical decisions and making sure we don't make any mistakes. And it's designed in a way that we give the constitution of how to use it to those health systems so they can be responsible in bringing AI to that industry. So I think that layer is quite interesting. There are a lot of companies that got started, like last year, for example, that would use the APIs of these language models and build these thin products on top. Those companies, I think investors will lose a lot of money on because they obsolesce very quickly. There's just not enough value in those particular companies in terms of what they provide.
It's a lot of dispersion. Thank you. Juan, Hamilton Lane reviews thousands of funds a year.
Yep.
And you have a very impressive database tracking managers over a long period of time. How are you incorporating technology in doing what you're doing in terms of data analytics and investment decisions? And then, I guess, are you seeing any pain points as you look at industry trends from your unique perspective that are coming in, that you're expecting in the coming years?
Yeah. I'm glad you picked me second, because now you cannot blame me for saying what General Catalyst just said, in the sense of every VC became an AI VC. Every company became AI. And we have the PPMs before AI and the PPMs after AI. And so it's not, so thank you for being honest and upfront. So that's one. But in terms of the nuts and bolts of your question, obviously, like any other CEO and any other company, we're trying to apply it and use it ourselves. We had a big data company in many respects as well, an investment manager in private markets, but data is essential. So AI is very strong in helping you handle large unstructured pools of data. And it has helped us screen, as we call it, hundreds of opportunities. We see about 1,500 funds per year. Our database is now at about 130,000 private companies, only private, and over sort of 50,000 funds through generations. So we feel much closer and much more in control of that data now that we put in place some of the tools. The considerations are also the ones that were mentioned, which is we don't want the Hamilton Lane data to be in the language model for everybody to be searchable. And so you ask, what would Juan say about this? And you just get the entire answer. So obviously, being able to handle that in our own company, so with the Microsoft solution, for example, have your own chatbot, and reduce the work it takes you to own the data that you are supposed to own and have at your fingertips, has been a big value add from that. But I think a certain degree of skepticism as you make your decisions is important, and I think that's what came through. I also feel that us as private market investors have a lot of wood to chop, just generally speaking, on technology, not just AI. So AI will be a portion of the investments we make in innovation, but as companies, we have a lot of investment to do in technology that is not just AI. And I think a lot of that was covered earlier in the FinTech conference. So we're still an industry that relies on papers. Really. I mean, ask anybody operating our businesses to discuss quickly limited partnership agreement terms. They are on papers. Someone has to pull up a PDF. In our relationship with our customers, we still rely on nearly faxes, pieces of paper flying over, wet signatures. Hey, Juan, you use a blue ink pen to sign, not a black ink. You know what? This is a real situation. So there's a lot of tech that is non-AI that we risk actually skipping because we are all rushing to do AI. So I mean, this happens to us all the time. We have a company, Hamilton Lane, out of our balance sheet, have been investing in technology that applies to private markets for over the last decade. And we invested in one company, which is called Tiffin. You can go check it out. As a management company. And nobody cared until we said that it was going to be an AI chatbot interacting with customers. That day, everybody took notice. And so, to some extent, that's great, but I think we need to still get our technology level one step up and our interaction with our customers to a better level before we're in a position to use AI.
I couldn't agree with you more. Nate, CD&R invests in companies, in numerous portfolio companies with the idea of building sort of long-term value. So how are you evaluating the risks and the value in these portfolio companies as we're thinking about disruptive technology, not just AI, but just disruptive technology and the trends we're seeing there?
Sure. We spend a lot of time on the topic. We have in our firm a group of former CTOs who help us in our due diligence, both from a commercial standpoint and assess both the risks and the opportunities that evolving technology presents to the companies, as well as to think about process improvement, cost reduction opportunities that technology applied to process flow can yield. We think about it for our own firm too. How do we make ourselves more efficient and take out some of the waste that is inherent in our industry? So it's a big topic for us. It's a big deal. Having said that, and at the risk of maybe being labeled a Luddite, I get asked a lot, is it going to fundamentally change our industry, much as it has data analytics, machine learning, and now AI has really changed the hedge fund industry? And I think no. You know, at least in the later stage private equity, so much of what we do, the way we do it, it's relationship based, it's catalyzing transactions that create value for all involved. It's the operating capability that we bring to businesses after we invest. And so the idea that somehow that can be automated, even as AI continues to advance, I think we're a very, very long ways off from that. So I think it can help our business. I think it can drive value creation. I don't think it fundamentally disrupts our industry.
So just something else to watch. Thanks, Nate. The other big topic that we've been exploring over the conference has been ESG. So I just wanted to touch upon ESG. managers and LPs alike are actively engaging, and given sort of the control nature of private equity and the deals that you do, many people believe that PE managers have a really important role to play. So I guess I probably just want to really explore how you're implementing ESG policies across the portfolio companies that you're working with. So I might stay with you, Nate. So from your perspective of sitting on multiple boards and investment committees, what role does ESG play as you build these great long-term businesses?
Sure. You know, we view, as stewards of businesses, we really view our role as making our businesses better in virtually every aspect. You know, that is what we're supposed to do during that 5 to 7 year holding period. And it means strategically we should reposition the businesses, we should position them for greater growth, we should drive productivity and returns on capital, and we should drive culture, and we should drive impact. And impact, you know, the elements of ESG are all part of that. Philosophically, we think that's the right thing to do, as we think of ourselves as stewards of businesses with pretty significant reach. But I would say even if we didn't have that philosophical view, it is clearly the right thing to do from a value creation standpoint. We exit most of our businesses to either to the public markets or to strategic buyers. Those two sets of buyers care a lot about the sustainability of our businesses, sustainability in the sense of visibility into ongoing value creation, and increasingly sustainability in the sense of impact. And so even if we didn't have that philosophical view and we're just thinking about how do we create the most value in our businesses, the focus would be the same. And so I think this debate, you know, should ESG be a factor within the investment strategy? I think we're well past that, because it is now fundamental to a value creation process, and we've embedded it within our deal teams. You know, our deal teams are responsible for the investment strategy and for driving the business and for operational performance and financial performance and performance against the elements of ESG, because it does in fact drive value at exit.
Thank you. Juan, you also have a similar vantage point as you sort of...
He's getting a free pass on the corner.
I'm going to come to him in a minute, don't worry.
Yeah.
So you sit on various investment committees as well. So you work with many PE managers. So I'm curious to sort of, like, what's your viewpoint on this, and what trends are you seeing with the managers that you work with?
Yeah, I like the way Nate phrased it, which is it's over, you have to operate within an ESG compliant framework. If you interact with people like us or the clients we represent, you get sent an ESG questionnaire, and if you don't pass that, it's not going anywhere. So the framework has changed, and for us as companies, just as we apply to the investments we review. So then what's next? Let's talk about the problems. We have two fundamental problems, I think. Number one is data. Number two is kind of choice. Number one, data is we as causing the pain in the market, in the managers of gathering ESG-related data, can tell that there's no software solution out there. And so one of the things we went out and did, it's going to sound like an advertising on my investing for the management company, but we went out and co-founded a company called Nevada, which begins with the premise, you could say it's a software company, but begins with the premise of no more templates, no more one set of key metrics for the whole industry. Don't try that. But if we had a software platform that was common to us, then the company that in Nate's portfolio that defines the KPIs from an ESG point of view that are relevant to that industry can use the same. Those companies can report to Nate, Nate reports to me. And the next company, the next sector that has different KPIs, different targets, then can use the same platform. That's a good thing. So it's not about a common set of standards and a rigid, oh, Juan said that's the template. No, forget templates, forget what Juan said. It's about trying to find a common platform that is flexible on the definitions of KPIs and get more of that data. And that can lead us to benchmarking, that can lead us to more comparison, can lead us to sector definitions. And so we invested in that. We've done a couple of rounds, Microsoft and Ford Foundation and others. We're not the only investor, but we pitch it every time because we think it's something that the industry should consider. So that could go one way. We thought that was our responsibility to do on the data side of things. On the choices, what I mean by that is that if you travel the world, and I have the luxury of doing that, I have a global role based in Hong Kong, but I get around a fair amount, and it's very different, right? And it's been said before on the stage, so I won't belabor the point, but it goes from meaning something very specific in some parts of Europe to not being welcome at all in the conversation. Oops, did I say that? And in Texas, or all the range. So investors, and from an investor point of view, goes from a loose ESG framework compliance all the way to impact, which Nate mentioned. By the way, it was said earlier today that returns have been mixed. Our returns on impact are very good, so it's non-compromised. That's not the issue. So what I mean by choices, what I think we need to do on the private market side is provide more choices alongside the ESG spectrum for investors to make that choice. So far, clients don't agree. And that's probably the way it's going to stay forever. They will not agree on what level of impact they want to invest in. And nobody, by the way, has sold a portfolio based on ESG considerations. So we are all owners of assets pre-ESG revolution, and we are all unclear as to which level of impact we want to invest in. And that's okay too. We should not expect that to go away. Talk about the navigating complexity. So we think it's part of our solution to try to gather kind of KPI definition, template neutral data, as well as to provide investment choices, clearly delineated for clients to make that choice.
So substance, flexibility, and value is what I'm hearing from you. Hemant, is ESG right for venture capital?
Yeah, so I think first thing is we are deep believers in the philosophy behind ESG. I think at our firm we believe that there's a false choice between impact and financial return, because the companies that really get to endure and be compounding investments are the ones that are actually positively impacting society. And so in that sense, we're big believers. We think ESG is tough in its evolution today because a lot of times the data is not accurate, standardization isn't there, and the focus is on short-term compliance versus really thinking about long-term, are we having that impact? I mean, as an example, no judgment on the company, but Tesla was considered not an ESG company, but it's literally an important company moving us towards electrification and transformation in the climate change world. Well, how is that not an ESG company on a long-term basis? So I think there's a lot of thinking that has to get done on what is ESG really, how to really accomplish this. Now, in our business, where you're actually starting companies, and if you agree for a moment that these companies will be a significant part of GDP worldwide in relatively short order, there's no data, and these companies don't have the ability to have an overhead to even be following these kinds of compliance regulations. We have been developing a framework that we call responsible innovation, which starts with the mindset of the founders, and are they thinking about things like sustainability, inclusive prosperity, integrity, and respect of human beings in the way they build these companies. And then we think about what are the mechanisms with which you actually implement that in terms of inputs into company building versus ESG, which is largely measuring outputs of a business. And their business model choices, supply chain decisions, product decisions, what we call algorithmic canaries, on how you measure in long-term unintended consequences of your product decisions. How do you do these kinds of things much more intentionally from a company building perspective? And so, you kind of have to go from this inputs orientation in the early days to then, hopefully a refined version of ESG, and maybe your platform will help us get there, that can then be used by larger companies.
Thank you. Thanks so much, Hemant. I think we've got a couple more minutes. I've seen that some questions have come through, so I might read out a couple of those questions. So, question from the audience: do you see any good opportunities for blockchain-related investments? And related to that, will decentralized finance become the mainstream of financing models in the financial industry? So, not sure who wants to take that. Hemant,
That's
Nate?
pretty clear.
Sure.
Yeah.
So I think when we think about blockchain, there are two things. One is there is no decentralized finance in the long term. if you don't interoperate with fiat and sovereign finance in the short term. And this is the big mistake that this ecosystem made with its hubris, which, there's been a lot of lost money and carnage in that industry. So that's sort of a design principle for us. In fact, in 2017, we internally said greed is the killer app in crypto, and we're just not going to go there. And that's really what everybody was innovating around. The second thing I would say is the mimicry around how to use blockchain to replicate what happened in Web 2 was, in hindsight, a mistake. You don't need to go build a new Pandora, which is decentralized when people like, or Spotify, which people like it enough as it is today, right? So going and trying to replicate these things where you will have suboptimal consumer experiences in the short term just because it's on blockchain, like why would consumers switch? And a lot of the innovation was done towards that area. In our view, I think finding examples where trust matters more than consumer experience, and therefore cloud actually did not successfully penetrate, are more interesting areas to think about using the blockchain technology. So as an example, we've been building a company around how do you put consumers' health data on chain so that it can be shared in a democratized way, and the consumers have control in the US. I mean, today, if somebody has cancer, their family is going bankrupt because they don't know what to do in terms of taking care of themselves, while some middleman company is enrolling that person in a clinical trial and making money on it. Well, it's their asset, and how do we actually move that entire industry onto chain so the consumers directly benefit for their data? So looking for examples like that where the existing models didn't really crack it. Carbon credits is another one. The agencies that determine the efficacy of the carbon credits, we talked about this yesterday, are quite inaccurate, and there's not sort of a standardization, and there's not a lot of trust in how those projects really generate credits. Well, how about we put that on chain and actually create a new process? So I think those kinds of examples is where I want to see entrepreneurs building and demonstrating value in the short term.
Thank you.
Can I add just a quick one
yeah,
on that?
of course.
And the other industry ripe for that is private equity. So I think actually blockchain has a lot of smart contracts, and having our relationship on chain is a game changer for private markets. In that respect, we could leapfrog a lot of the steps that were taken by public markets, but blockchain as technology, not crypto, but it's ideally designed to bring ourselves away from the operational friction that we currently have, to much more of a liquid or much better operational environment in private markets, which has a lot of consequences in terms of the investability of some of the assets we handle, and getting ourselves from T plus 90 days, which is where we are now, to T plus 2 or closer to, I think. And a lot of that it has to do with tokenization, and there's been great initiatives, and just generally speaking, we bring in more the ID registers to the chain within private markets.
That's probably a good segue for me. In terms of wrapping up, I'd love to ask the three of you opportunities that each of you are excited about, and then also what are the prerequisites for those opportunities to play out? I'm going to start with Nate from a buyout perspective.
Sure. Maybe it circles back to where we started. These are uncertain times, and I think people are feeling the potential disruption. That causes for us, founders, corporations, to rethink their strategy, their portfolio. And so the opportunity to bring capital, to bring solutions to people in this environment that creates value for them as sellers really is the thing that allows us to both create value for them and then create interesting transactions for ourselves. And so these more disrupted, more uncertain environments are actually really, really interesting for our particular business model.
Thanks. Juan, from a global solutions perspective.
Well, I'm sitting on the same chair Howard Marks was sitting in America. I'm not going to say credit. But I will say one thing that was said earlier. I'll overemphasize secondaries. So within private markets, buying from other LPs or buying from funds, providing liquidity to GPs, is shockingly small, and as in less than 2%. So just think about that of any other industry where the turnover of existing inventory is just 2%. It has to grow. The selling interest annually is about $250 billion, of which only about 125 actually closes. How do you like to be a buyer in that industry, right? And for all the talk about 10% for senior credit, 11%, 12%, no portfolio of secondaries has ever lost money at a fund level. So I like my downside on that, and we are writing 15 plus with upside to it. So it may sound like a minority, it may sound like connected to distressed environments, but secondaries, go big in secondaries in this environment is one of the easiest things to do in our mind.
Thanks, Juan. Hemant?
So our investors give us money to invest in the future, live in the future. And I think when you think about the era today from an innovation standpoint, AI, AR, biology, blockchain, all these technologies are about to inflect. Some are further ahead, some aren't, but it's all in the next 5 years. These things are going to inflect, and there's a lot of interesting companies that are going to get built. So that's exciting. The idea I'm walking away wanting to think more about and be inspired about after this last couple of days is more about what is the model for borderless innovation? So going back to my comment earlier about the Greater Bay Area, thinking about how we're going to take on problems that truly are global, climate change and pandemic resilience, for example. We need a new model where innovation actually can lead to uplifting countries all over the world at the same time versus being stuck in this increasingly bipolar world. And can we come up with a way to innovate with that mindset across the globe? I think that'd be really exciting and could lead to some amazing companies who can figure that out. So I encourage all of you to think about that.
I love that point to end on. So I just want to say thank you to the audience. Thank you to these three gentlemen. It was just fascinating conversation, really unique viewpoints as well. And while these trends are here to stay, I think client capital is in good hands. So thank you very much.